Hello, everyone. I'm Maxwell Sanchez. A little bit about my background. I've been in crypto since 2012. In 2015, when I was still in high school, I started a blockchain company that went on to do a successful $10 million IEO a few years later. And I've watched crypto exchanges evolve from a little buggy PHP site running on somebody's old repurposed desktop in their basement to a $100 billion plus industry that's disrupting global finance and challenging and pushing regulations to the brink of what we ever thought we would see. And today, I'm going to take the next 5 minutes and share with you a little bit about what I've learned about liquidity and how the markets function, both in traditional finance and in cryptocurrency. And we're going to look at how technology today, in the last couple of years with the advent of DeFi, has been transforming liquidity, markets, and making them more democratized, efficient, transparent, and fair. So first of all, what is liquidity? Most of you are probably familiar with the term, but liquidity is essentially how easy it is to get into or out of a position in a given market for a given asset. And why is that important? Well, let's take Bitcoin, for example. Bitcoin is a highly liquid market. And what that means is if I want to buy $100,000 worth of Bitcoin, I'm not going to move the price very much. I'm not going to be fighting against myself as I push the price up and buy into the market. And when I turn around to sell my position, I'm going to do the same thing on the way down. I'm going to get a very good fill because I'm not chasing the market down as I sell into it. But with a much less liquid asset, for example, generic coin, which doesn't exist, but you all probably know of a few generic coins, it's a very liquid market. And so when I'm buying in, if I buy $100,000, if I can even get that much of the asset, I'm moving the price up and I'm fighting against myself to acquire my position. And then, of course, when I sell it, I turn around and I do the same thing. And if I've learned one thing in the last 9, 10 years of being in crypto, it's that illiquidity is basically the bane of adoption. It doesn't matter how good your technology is, how well you market it, how well you explain your idea, how easy it is to use. If you don't have liquidity, people can't get involved in your project. And if they can't get involved in your project, it collapses. And the problem with that is it's a feedback cycle, because if you don't have liquidity, no one's going to trade in your markets. And if nobody's trading in your markets, you're not going to have liquidity. So how do assets break this cycle? Well, in traditional finance, oops, could we go back one slide? Actually, no, we're good, sorry. So in traditional markets, you have market makers, or in some cases, they're called specialists, and they're basically required by law and regulations and contracts to always be willing to buy or sell large amounts of a particular asset at any point in time. And this, of course, reduces slippage. You can get in and out of big positions because the market makers are there. But unfortunately, you're giving them a license to steal, to manipulate markets, to steal from the retail traders and enrich their own pockets. And it's not just a theoretical thing. They do this all the time. Up here, we have a thing from the SEC from the 90s investigating market makers, 2006, 2010. And more recently, you've probably seen the controversy over payment for order flow and things of that nature with market makers and brokerages as well, with the whole meme stock trading, Wall Street Bets, GameStop, Robinhood. It's all the work of market makers. They can put up fake trades on markets, they can spoof, they can manipulate volume, they can fake volume, wash trade, naked short sell, you get the point. They're harmful to the market when they misbehave, and the only way that we can keep them honest is through regulations, audits, and enforcement actions. So let's take a look at traditional centralized crypto exchanges for a moment. These are your Coinbases, your Binances. On these markets, it's very, very similar. Usually the project who's getting listed is the one that hires a market maker, but not always. And in crypto, a project will go to a market maker when they eventually find one, and they'll give them a bunch of their own native coin or token, and they'll give them a bunch of Bitcoin or Ethereum or USD or whatever needs to be traded for the counter pair. And they'll also pay them a large monthly fee, and that market maker should, ideally, go and provide liquidity on that market. But again, you're giving them a license to steal. They can buy up the market with your asset and sell into it with their own proprietary capital. Again, they can fake volumes, spoof trades, run away from the market when it gets highly volatile. And we don't even have regulations really to help us there. And so it all comes down to contracts and auditing, and again, that's not a good model. So in comes DeFi, DeFi to the rescue. What DeFi does is it takes these same models and says, well, what if we democratize them? And what if we use code and math and cryptography instead of regulations and policies and rules and auditing? And DeFi kind of went through, I'd say, 3 phases of the liquidity revolution, if you will. The first phase was your decentralized exchanges, particularly your curve-based decentralized exchanges, where essentially everybody was able to crowdsource their liquidity together and act as the exchange. And many of you are probably familiar with liquidity pools like Uniswap or SushiSwap, where everyone puts in their assets, and then they all get paid as people trade and buy against that liquidity pool. And of course, they take risk of a permanent loss because they can get taken out of or put into certain positions that may be unfavorable to them, and they're compensated for that risk. Then there was a second wave where they said, well, OK, the way curve-based DEXs work is great, but it's not very capital efficient because you're basically allocating your capital over from price 0 to price infinity. And so you get a lot more slippage than if people could concentrate their liquidity in a certain way in certain segments of the market to more efficiently use that capital and reduce slippage even further. And so V2, or kind of the second layer of DeFi innovation around liquidity, was this concentrated liquidity idea. And then more recently, in this wave 3, we're seeing new protocols that allow liquidity to be dynamically allocated in an open market between different areas where that liquidity can be pointed based on market demand. And so it further democratizes liquidity and further opens it up so that everyone can participate, whether you have $10 or $1 million that you want to add, and it further flattens the market, helping everybody. So DeFi took regulations and replaced them with game theory. It took contracts and replaced them with smart contracts or code. And it took policies and replaced those with cryptography. So what if we could do the same thing? What if we could bridge all those benefits and ideas that DeFi provides and that we've seen work? We see billions and billions of dollars locked up in DeFi protocols providing liquidity for the future of the world's financial economy. What if we could take that and bridge that back to centralized exchanges, back to your Coinbases, your Binances, your NASDAQs, your NYSEs? That's what I'm working on with a project called EMI, or the Ethical Market Making Exchange, which is basically taking all these DeFi innovations and finding ways to translate them to centralized finance, whether it be centralized crypto exchanges or the NASDAQ, the NYSE, et cetera. That's EMI. We have a booth in the exhibit hall. We'd love to see you there, either to talk about what we're doing or talk about liquidity in general. Thank you.